What do you anticipate the significance of a Taylor as Fed chair would be?
I think it would be significant if Taylor is appointed, because he is, we think, the most disruptive potential candidate. One aspect is he's obviously, a well-regarded monetary economist, which means he would actually be able and willing to take on the Fed staff around their thinking around policy. And we do think, therefore, he's going to be more challenging for the Fed. He's going to be more challenging for investors to work out what that means for Fed policy. I think we would get some repricing, particularly at the short end of the curve. But as we saw yesterday, in terms of what happened to the long end, then the market starts sort of flattening the yield curve. I mean, there's a limit to how far, I think, however hawkish the Fed chair or the new Fed might be, they can actually be pushing the market and pushing rates higher without the market then pushing back and saying, hold on a minute, we're not quite sure that we're ready for this, and then we have some flattening in the curve.
It's obviously hard to know until a man or a woman has the job.
Yeah.
Often the job changes them.
Yes.
But it might be one thing to be a professor at Stanford and to have a very interesting theory that people respect on the one hand. On the other hand, actually be in the job, and you have to think about the markets and how they'd react. Because, according to the basic Taylor curve, I think we should be like 2.5% higher than we are right now, a large number.
Yeah. Yeah, no, absolutely. And I think the other aspect, obviously, to bear in mind is the institutional strength of the Fed, and in particular the FOMC. And being a difficult situation, because right now the centre of gravity within the FOMC is not for moving to a more accelerated path for Fed rates. And if we think back to the Paul Volcker era, there was one time when they actually had to take a second vote because he was going to be outvoted, which would have been very embarrassing for him, maybe even a potential sort of resignation issue. So he's got to bring the rest of the Fed and the FOMC with him. But nonetheless, it would, as I say, mark, I think, potentially a significant shift.
And the difference between the short end and the long end when it comes to that, like you mentioned, we saw the reaction in the short end. Ed, we talked to Steve Major of HSBC. He's one of the lowest calls on the street. He sees 1.9% on the 10-year by the end of the year. Here's what he had to say.
I'm struggling with the idea as to why yields go up, and 99 out of 100 people we meet seem to be convinced that's what's going to happen. Now, to me, the burden of proof goes with that camp, who have been saying it all year. In fact, the yields have been sliding down in the 10 years. They've been right at the front end, that's true, but the reality is the 10-year has fallen this year.
To be fair, he sees like 2.3% next year. What do you see?
We're still looking for rates to be a bit higher, more in the 2.75% to 3% range. And, we do think, over the longer term, inflation is what will drive the longer end. And, I think it's certainly worth discussing and thinking about the influence that the Fed's path to unwind its balance sheet will have on the longer end of the yield curve. And, at more like a 2.75% to 3% range. And once again, this is in the backdrop of still expecting reasonably strong economic conditions, not just in the U.S., but globally, and that's going to continue to drive the long end higher.
So the tip auction this year, $30 billion, you can be buying that?
We may be.
You may be. When do you see inflation turning then?
That's been the kind of key focal point for markets to focus on. We do think there was some anomalies potentially in the summer that caused a bit of that downdraft. So as we move forward, even in this next kind of 3 to 6 months, we think there's a likelihood to see a bit stronger momentum to it.